And the U.S. Bureau of Labor Statistics announced the consumer price index for August at 8.3% year on year. It's been 6 months now that inflation rates in the U.S. continue to soar above the 8% mark, which are historical highs. CPI rose around 0.1% month on month. The expectation was that it will contract by 0.1% per month. So if you look at the graph, since June, inflation numbers have improved, right? It's gone from 9.1 in June, 8.5 in July to 8.3% in August. The problem is the expectation was that inflation would go down to about 8.1% because gas prices in the United States have been contracting. As a result, you've seen weak opening in the U.S. markets. The Dow Jones down nearly 900 points as we speak, over 2.5% in the red. The S&P 500, 3% in the red, and the NASDAQ about 4% in the red, about 5% down, 500 points down at this point. So what does this tell us about what the Fed will do next? Because frankly, that's the question. Peter Cardillo, Chief Market Economist, Spartan Capital, joining us on the show. I'm also speaking with Paul Hickin, Director, S&P Global Commodity Insights. Welcome to both of you, and thank you for speaking with us this evening on the India Development Debate. Peter, let me begin with your take. A 75 bips hike, further hike by the Fed has largely been factored in. Does that now become a sure shot after today's numbers?
I think that that's a given fact that we're going to see 75 basis points hike next week. I think that opens up the debate whether or not we see a 100 basis point hike in November. I don't think so, but of course, you know, we still have we'll still have a few inflation numbers that will come out before November, and so I think 75 basis point is a hefty rise, and that's a near given at this point. The real question is, does the Fed have to raise rates going into the new year? Will a 4% Fed hike, Fed fund rate be sufficient? I think that's what the markets are really afraid of, and that's why we're seeing yields move back up today. In fact, the 10-year is at a new 52-week high, and of course, we're seeing the dollar very strong and stocks under severe pressure.
Paul, your take on what we see next, and are you worried about this 8.3% figure?
Well, I think first of all, it's the core CPI, which we should be really looking at, and what the market's really looking at, and that rose 0.6% month on month, and that compares to 0.3% in July, and it takes us back to those 0.6, 0.7% month on month figures from core CPI, which strips out the volatile food and energy prices and takes us back to those worrying numbers. And so what you're seeing from the market is that this 75 basis points that's likely next week, the market had a slight expectation that could be 50 basis points. Now that expectation shifted to the other side, as Peter referenced. It actually could be moved towards the 100 basis points even next week, and that's where the market expectation is shifting from that 75 basis points, which is still the central scenario, but the 100 basis points, and whether and how much just the Federal Reserve is likely to get that aggressive to get ahead of the game. It's talking about trying to rein in inflation, but at the same time, that's a blunt tool that the interest rates rises, because it hurts the economy, and what we're seeing in the commodity markets, which is this demand destruction which is happening across commodities, but at the same time, prices of all commodities, food, oil, gas, are still extremely high.
The question is that overall, what is this telling us about the economy, Peter? Because you have mixed data, I would say. Jobs data is looking upbeat. You also have household expenses looking fine as far as the U.S. economy is concerned. So are the concerns over inflation and an aggressive Fed response now waning? Would that be fair to say?
Well, look, there's no doubt that, from a technical viewpoint, we're in a recession, a very peculiar one at that. But with the Fed continuing to be aggressive, we're going to go into a full-blown recession. And the good news to that is and in fact, we saw that in today's CPI report, that energy prices are headed lower, and that will help bring down inflation. The problem here is that inflation is being driven up, not by energy costs, but it's being driven up by food costs. And that's a transitory inflation hike, but yet very difficult for the Fed to control. You have several forces at this time that are very permanent in the marketplace. One, you have bottlenecks of grain exportations. You have, and that's the war factor, and then you have Mother Nature. In some cases, it's having a negative effect on crops, and so the Feds can't do very much about that, but they can, induce a recession, which they are, and that means lower demand for energy prices, and probably we'll finally get to see a peak in higher rental prices. And the reason why we're seeing this constant increase in rental prices is because prices had reached to levels where the income was very, very inferior to what it should be. And so we're seeing prices in the housing market level off and actually come down, but yet we're seeing rents continuing to rise. And that's the catch-up game. At one point, that will stop.
Paul, the concerns over heading to a recession, and Peter is quite unequivocal that the recession is coming. Is part of that concern also fueled by the fact that the Ukraine-Russia conflict is not showing an end at this point? Gas prices are going up all over Europe, and those repercussions are going to be felt around the world?
Well, that's the issue. What Peter referred to about what control does the Fed have over inflation? Well, that's a big concern because energy, commodity prices are all extremely high. They're all feeding through into inflation, even on a secondary, not necessarily on a direct level, but on a secondary level, because everything we do is touched by oil and gas. It also, but at the same time, it has a price income effect. The fact is that as you hurt demand, as the higher interest rates, people have less spending, it hurts demand. Where does less spending go exactly? And that hopefully brings down some of the inflation, but at the same time, and some demand for energy, but at the same time, we still need the lights on. We still need to heat ourselves through winter, and that is also a concern. And there is that sort of two-way process, but how much the Fed drives the U.S. economy into recession, and how much that actually reins in inflation, because being aggressive on inflation also means being aggressive on the economy. So it's a double-edged sword.
The figure for the month of August is not good as far as the US inflation numbers are concerned, and it's a number that in a sense impacts the world because it impacts the next move that the Federal Reserve may take. A 75 basis points seems a given in terms of a hike next week, but could there be even a steeper hike in November now is the question. Thank you so much, Paul Hickin and Peter Cardillo, for joining us today. Now, an interesting comment